Okay, so you want to buy a shopping mall. Not build one. Build one and you're spending hundreds of millions before a single door opens. No, you want to buy one. The way people buy them now, which is cheap. Find 1 million square feet of enclosed retail in a decent suburb, pick it up for less than what a small apartment complex costs, and step into a business where 100 different tenants send you money every single month. The listing makes it look almost too easy. A building that cost $250 million to put up in the late 70s, offered today somewhere in the low 20 millions. That works out to around $20 a square foot for steel, concrete, plumbing, climate control, escalators, 60 acres of parking, and a location that sits at the interchange every driver in the county uses. 4 anchor stores on the corners. Occupancy in the high 80s. A stated yield on the asking price north of 12%, which is roughly triple what an apartment building in the same town would pay you. You've heard for a decade that malls are dying, and that's exactly the appeal. You're not buying at the top. You're buying at the bottom from a seller who has to sell, and everybody knows the money is made on the buy. Here's what the offering memorandum doesn't show you. It doesn't show you the deed. Let's start with what you think you're buying, because the gap between that and the legal reality is the entire story of this business. In your head, you're buying a mall. One building, one parcel, one owner, you. Walk the property line on a map, and it's a clean shape with a highway on one side and a ring road around it. Pull the actual parcel map from the county, and you get something different. In most enclosed malls built between the 1950s and the 1990s, the developer did not own the anchor stores. The department stores owned their own buildings outright. In a lot of cases, they owned the land under them and a portion of the parking field around them, and a strip of the ring road connecting them to the public street. They didn't lease from the mall, they were partners in the mall. So what you're buying is the middle. The corridors, the food court, the inline stores between the anchors, the common area, and whatever parking wasn't deeded away 40 years ago. On the map, it looks like a donut. You own the ring and the hole. 4 other companies own the corners. That structure exists for a reason that made complete sense at the time. In 1974, nobody would finance a mall without department stores committed, and the department stores were bigger and richer than the developers asking them to come. They had leverage, and they used it. They didn't want to be tenants, exposed to whatever a landlord might do in 20 years. They wanted to own their box, control their entrance, guarantee their parking, and be legally protected from anything the mall might become later. The document that got all of that written down is called a reciprocal easement agreement, or sometimes an operating and easement agreement. Everyone in the business just says the REA. And that document, signed by people who are mostly retired or dead, is the single most important asset or liability attached to the property you're about to buy. Here's why. The REA doesn't just say who owns what, it says what everyone is allowed to do. It sets the hours the mall has to be open. It sets the standards for maintaining the common area. It says what the building can look like and where signs can go. It sets a minimum number of parking spaces that must be maintained, expressed as a ratio, usually something like 5 spaces for every 1,000 square feet of retail. It draws no build areas on the map, zones where nothing can ever be constructed because an anchor wanted an unobstructed view of its own entrance from the road. And it says that material changes to the site plan require the written consent of the anchor parties. Read that last part again, because it is the trap under the whole purchase. You can own the building free and clear, have the cash to redevelop it, have a city that wants the project, have a tenant ready to sign, and still be unable to move a single curb because a company that hasn't operated a store in that building since 2016 has a consent right written into a contract from before you were born. And you inherit that document. It runs with the land. It doesn't expire when the store closes. It doesn't expire when the company goes bankrupt. It gets sold as an asset to whoever buys the box out of the estate, which is frequently a liquidator with no interest in your redevelopment plan and every interest in being paid to sign. Now put a number on it. Say your mall sits on 80 acres. The enclosed building covers about 25 of them. Roughly 50 acres are surface parking, which in a suburb with a working highway interchange is the most valuable dirt you own, because parking lots are flat, dry, already graded, already connected to sewer and power, and zoned commercial. A developer would pay real money for a 5-acre pad on that ring road. You cannot sell it. The parking ratio in the REA requires those spaces to exist. Take 5 acres out of the field and you fall below the ratio, which puts you in default with every anchor party at once. So the most liquid, most immediately valuable piece of the property is legally frozen by a maintenance standard written for a Christmas season in 1979, when the lot actually filled up. You bought the property. You did not buy the right to change it. This is where the first trap opens, and it's also where new owners discover that the purchase price was the cheap part. Take that stated occupancy number, the high 80s. Occupancy is a snapshot, and a snapshot only tells you about today. What matters is the lease expiration schedule, which is the list of every tenant and the year their deal ends. In a normal mall, 10 to 15% of the leases expire every year. That's by design. Nobody wants all their leases coming due at once. But it means that in any 5-year period, more than half of your rent roll has to be re-signed by somebody. And a lease is not something you collect. A lease is something you buy. Here's the math nobody puts in the marketing package. A national inline tenant, say a shoe retailer taking 3,000 square feet, doesn't just move in. They want the space built out. The landlord pays a tenant improvement allowance, which on a mall inline space runs somewhere between $40 and $80 a square foot, depending on what condition the box is in. Call it $50. That's $150,000 in cash before the store opens. Then there's free rent, 3 to 6 months of it, because the tenant has to build and stock and hire. Then there's the leasing commission to the broker, which on a 10-year deal is often 4 to 5% of the total rent. So if the deal is $50 a square foot for 10 years, that's another $60,000 or $70,000. So a 10-year lease on one small store costs you north of $230,000 up front to produce $150,000 a year in rent. The lease is good, but you paid for it in year 1 and you collect it over a decade. And if the tenant fails in year 4, which retailers do constantly, you never get the rest. Now scale that. If 50,000 square feet of inline space turns over in a year, which is completely ordinary in a mall of this size, you are writing checks in the low millions just to keep the occupancy number where the seller said it was. That money doesn't show up anywhere in the yield you calculated from the listing, because the listing showed you net operating income, and net operating income is measured before leasing capital. That's the sentence worth remembering. Net operating income is not money. It's rent minus the cost of running the building, and it stops counting right before the largest recurring expense in the business. The number that matters is what's left after you've paid for the occupancy you're bragging about, which is why so many mall buyers do the thing that looks clever and turns out to be fatal. They stop spending on leasing. It works beautifully for about 18 months. Cash flow improves because you're not writing improvement checks. Then the leases roll, and the tenants you didn't pay to keep go somewhere that did pay, and the occupancy that took a decade to build starts unwinding in quarters. Now, here's the other side of the ledger. And enclosed malls have a specific problem here that strip centers and office buildings don't. An enclosed mall has an enormous fixed cost floor that has nothing to do with how many tenants you have. You are heating, cooling, lighting, cleaning, insuring, and patrolling several 100,000 square feet of corridor, atrium, restroom, and food court that no one pays rent on, ever. That's not overhead, that's the product. The corridor is what tenants are buying access to, so you cannot cheapen it without destroying the thing you sell. Run the building at 90% occupancy and it costs a certain amount. Run the same building at 55% and it costs almost exactly the same amount. The chillers don't know. The roof doesn't know. Half the mall going dark doesn't have your utility bill, because a dark wing still has to be lit for safety, conditioned so the pipes don't freeze, and the humidity doesn't ruin the drywall, and walked by security so the copper stays in the walls. And you don't get to bill all of it out. Common area expenses are charged back to tenants in proportion to the space each one occupies, which means the vacant share has nobody to send an invoice to. Say the building costs $8 a square foot a year to operate across 1,000,000 square feet of leasable space. That's $8 million. At 90% leased, you recover about $7.2 million and absorb $800,000 yourself. At 55% leased, you recover $4.4 and absorb $3.6 million, and that $3.6 comes out of the rent you're paying tenants produce. It's worse than the ratio suggests, because the leases signed most recently, the ones you handed concessions to get, frequently cap how much a tenant's share can rise in a year, or convert it to a flat amount that never moves. The tenants you fought hardest to sign are the ones contractually protected from carrying the building. Every point of occupancy you lose hits you twice, once as missing rent and once as an expense with nobody left to bill. Then there's property tax, and this is where mall ownership stops being a private problem and becomes a public one. A regional mall is often the single largest taxable property in its municipality. It's normal for one mall to represent between 5 and 20% of a small town's entire commercial tax base. So when the mall's income falls, you do the rational thing and appeal your assessment. If the mall was assessed at $140 million and now generates income that supports a value of $30, you have a strong case and you'll win. And towns lose these appeals routinely. Some of them lose them retroactively and have to refund years of tax. Congratulations, you cut your largest fixed expense by 70%. Now watch what it did. The town just lost a large slice of its budget. It cuts services, defers road work, maybe cuts the school budget, maybe raises residential rates to cover the gap. Households in the trade area get a little poorer and a little more annoyed. Retail sales in the trade area soften, your tenant sales soften with them, and your rent, as you're about to see, is a direct function of your tenant's sales. That's the loop most people never see from the parking lot. The mall's decline shrinks the tax base, and the shrinking tax base feeds back into the mall's decline. This is why a struggling mall so often takes the surrounding half-mile of retail down with it, and why cities fight so hard and spend so much public money to keep a dying one breathing. Here's where it gets interesting, because the way rent actually gets set in this business is not what you'd guess. You are not free to charge what you want. There's a number that governs everything, and every leasing director in the country lives by it. The occupancy cost ratio. It's the tenant's total annual cost of being in your mall. Base rent plus their share of taxes and common area charges, plus marketing fees, divided by that store's annual sales. Retailers have a hard ceiling on that ratio. Historically, a specialty apparel store could carry occupancy costs somewhere in the range of 10 to 15% of sales and stay profitable. Above that, the store's four-wall margin disappears, and then it's just a question of which quarter corporate closes it in. So the arithmetic goes backwards from what you'd expect. A 3,000 square foot store selling $500 a square foot does $1.5 million a year. At a 12% occupancy cost ratio, that store can support about $180,000 in total annual cost. Subtract their share of taxes and common area, call it $40,000, and the maximum base rent that store can pay is around $140,000. That's $47 a square foot, and it is not negotiable, no matter how nicely you ask or how much you spent on the atrium. Now let sales in that store drop from $500 a foot to $350. The store now does just over $1 million. The same 12% ceiling now supports about $126,000 in total cost, which after their share of expenses leaves base rent around $86,000. The store didn't close, traffic didn't collapse, nothing dramatic happened at all. But the maximum rent that space can produce just fell by 38%. And you will find that out on the day the lease comes up for renewal and the tenant's real estate director slides a number across the table that isn't an opening offer. It's arithmetic, and they'll walk on it, because a store that can't clear its ratio is worth more to them closed. You don't set rent. Your tenant's customers set it, one purchase at a time, and none of them have ever heard of you. This is why sales per square foot is the only number that actually describes a mall. Occupancy tells you how full the building is. Sales per square foot tells you what the building is allowed to charge. Two malls at the same occupancy, one doing $700 a foot and one doing 300 are not the same asset with different luck. They're different businesses, and the market prices them a factor of 5 apart, because one of them can raise rent at renewal, and the other one has to pay tenants to stay. And now, the piece that catches nearly every first-time mall buyer, because it's counterintuitive in a way that only makes sense when you understand that an anchor is not really a tenant. An anchor can close its store and keep the space. Go back to the REA and the anchor leases that came with it. Where the anchor owns its box outright, you have no say at all. It's their building, and an empty building on their land is their business decision. Where the anchor does lease from the mall, those leases were written when the anchor had all the leverage, which means many of them contain no continuous operation covenant, no requirement to actually be open. The rent is nominal anyway, often a few dollars a square foot, because everyone understood the anchor was paying in foot traffic rather than dollars. So the anchor closes. And then it does the thing that makes owners lose sleep. It keeps paying the nominal rent and keeps the box dark. For years. Why would anyone pay rent on an empty building? Because control of that box is worth more than the rent. Keeping it dark keeps a competitor from taking 140,000 square feet in a trade area they still sell into from the store 6 miles away. It preserves an option in case the market turns. And it keeps a redevelopment that might change the character of the property from happening at all, since they still hold their consent rights under the REA. You are now the owner of a mall with a 140,000 square foot hole in it, generating $3 a square foot, with the party responsible perfectly current on rent and completely uninterested in your problem. You can't evict them, they're paying. You can't fill the space, it isn't yours. You can't build around it. The site plan is locked. That's the difference between a vacancy and a dark anchor. A vacancy is an empty space you can sell. A dark anchor is an empty space someone else is paying to keep empty. So far, this sounds like a bad business that a patient owner could still grind through. Now let's talk about how these things actually die, because it isn't the way the headlines say. Malls did not die of the internet. Malls died of a capital structure. Here's the mechanism. Almost no large mall is bought with cash. It's bought with a commercial mortgage that gets packaged into a bond and sold to investors, which is where the term CMBS comes from. These loans have 3 features that matter enormously. First, they're usually 10-year, fixed rate, and often interest only, so you don't pay down the principal. Second, they're non-recourse, meaning if it goes bad, the lender takes the building and not your other assets. Third, and this is the one that kills, they're sized to a valuation on the day of the loan, and they come due all at once, on a specific date, in a single balloon payment. So a mall gets financed in 2014 at $180 million against a valuation of $240. Nothing catastrophic happens. Sales per foot drift down, a couple of anchors close, renewal rents reset lower along the way. By 2024, the mall still operates, still has shoppers, still pays its bills. But it now produces income that supports a value of maybe $60 million. The loan comes due. You need to refinance a $180 million balance against a $60 million building. There is no lender on earth for that trade. The equity is gone, and it was gone years before anyone stopped shopping there. What happens next is a process with its own vocabulary. The loan transfers to a special servicer, which is a firm paid to handle troubled loans on behalf of the bondholders. The servicer orders a new appraisal. That appraisal comes back at a fraction of the loan balance, which triggers what's called an appraisal reduction and changes how the bondholders get paid. And then the owner does the arithmetic on putting new money into an asset where they'll never see a dollar back and hands over the keys, which in the industry is a deed in lieu of foreclosure. The mall is now owned by a trust, run by a servicer, whose job is to sell it. And the price it sells for isn't set by what the mall is worth to an operator, it's set by what a servicer will accept to close a file. That's how a building that costs $250 million to construct transacts at $8 million. And it's why those listings you were so excited about exist in the first place. This ran through the whole industry, not just individual buildings. In November of 2020, 2 publicly traded mall owners, CBL Properties and Pennsylvania Real Estate Investment Trust, filed for Chapter 11 bankruptcy protection in the same month. Washington Prime Group, spun out of a larger mall company a few years earlier, specifically to hold the weaker properties, filed the following June. These weren't small private owners who got in over their heads. These were professional operators with hundreds of properties and decades of experience. And what took them down wasn't empty hallways, it was debt sized against yesterday's income. Which is why the survivors did something that sounds insane the first time you hear it. The largest mall owners in America started buying their own tenants. In 2020, Simon Property Group and Brookfield, the two biggest mall landlords in the country, bought JCPenney's retail operations out of bankruptcy. A landlord bought a department store. Simon had already been doing this in partnership with a brand licensing firm, picking up Aeropostale in 2016, and then Brooks Brothers, Lucky Brand, and Forever 21 as each one failed. Understand why, because it explains everything about how this business really works. JCPenney was an anchor in dozens of Simon malls. If it liquidated, Simon didn't just lose Penny's rent, which was small, it lost the traffic driver in those buildings, and it would have inherited a few dozen enormous empty boxes with all the consent rights and site plan problems we've been through. The cost of JCPenney disappearing was, to Simon, dramatically higher than the cost of owning JCPenney. So the landlord became the operator, not because retail was a good business, because losing the tenant was a worse one. And that decision comes with its own bill. Forever 21's American operations went through bankruptcy again in 2025 and wound down its U.S. stores. When your tenant is also your subsidiary, its losses stop being someone else's problem and start showing up in your own results. You have converted a real estate risk into an operating risk, and you did it on purpose because the alternative was worse. Which brings us all the way back to the deed and to what the real business of a distressed mall turns out to be. The valuable thing about that 80 acres was never the enclosed retail. It's the location. A highway interchange, utilities already run, commercial zoning already in place, and traffic counts that took 40 years to establish. That land wants to be apartments, medical offices, a distribution facility, a hotel, a county services building, a grocery-anchored center with an open-air layout that people actually prefer now. In almost every case, the site is worth substantially more as something other than a mall. The only thing standing between the site and its next life is paperwork, the REA, the parking ratio, the no-build zones, the consent rights held by 4 parties, one of which is a liquidating trust in another state, one of which is a company that was acquired twice since it stopped operating, and one of which has figured out exactly how much its signature is worth to you. That is why mall owners spend enormous sums buying back their own anchor boxes. They're not buying square footage. The buildings are frequently torn down within a year. They're buying the signature that comes with it. Every anchor pad you acquire removes a party from the REA and returns a piece of your own site plan to you. The redevelopment doesn't start when the financing closes. It starts when the last consent is bought. Sears understood the value of that real estate better than most people gave it credit for, which is why in 2015, it spun off hundreds of its store properties into a separate company, Seritage, whose entire business was supposed to be redeveloping those boxes into something worth more. It turned out that owning the right land is not the same thing as being able to afford to change it, and shareholders eventually voted to sell the company off piece by piece. Step back far enough, and the picture is simpler than it looks. The United States built roughly 23 square feet of retail space for every person in the country. Most of Europe built under 5. That gap wasn't a difference in shopping habits. It was a construction boom financed on the assumption that retail sales per person would keep rising forever, and it produced something around 2,500 enclosed malls by the mid-1980s. Fewer than 700 are left. The ones that survived didn't survive by being clever about tenants. They survived by being in the right 5 miles, with household incomes that support high sales per square foot, which permits high rent, which funds the improvement allowances that attract the tenants that produce the sales. The whole thing is one loop, and it runs in both directions with equal enthusiasm. The top malls in the country are doing record sales per foot and have waiting lists. The bottom of the market is being quietly converted into logistics, housing, clinics, and government offices, or scraped flat. There is almost nothing in the middle anymore, and there hasn't been for a while. So if you do buy one, understand what you're actually buying. Not a million square feet of retail at $20 a foot. You're buying a 50-year-old agreement between 6 parties, most of whom no longer exist in the form that signed it, and the slow, expensive, entirely unglamorous right to go collect their signatures one at a time until the land underneath is finally yours to use. The offering memorandum will never say that. It's the only line in the whole deal that matters.